and welcome to Moneycontrol. Just two more trading sessions before the final day of the verdict on June 4th. How do the markets react to June 4th results? What is the market really discounting for the June 4th? We have two marquee guests today, Pramod Gubbi from Marcellus Investment Managers and Jigar Mistry. Thank you, Jigar, Pramod, both of you for joining me this morning.
Thanks, Sonal, for inviting us.
First off, last 2 days we've seen some sort of a pullback. From May 9th we've had a one-way street. Markets have just gone up and up. Is this just some last minute nervousness that was inevitable? Is the market sort of discounting a status quo, or do you think otherwise? Jigar, you want to go first?
Yeah, sure. So I think, some amount of nervousness getting into sort of election results is par for the course, right? You look at the amount of seats that get decided on a minuscule vote, that's quite large. Like if I look at Bengal, just sort of West Bengal, just 4% vote swing can shift something like 12 seats in either directions. And with so many seats being decided at the margin, I think no amount of pre-poll, post-poll sort of analysis is going to tell us the final picture. In the process, I think what we have seen is the net open positions for FIs until I think yesterday was squared out. Market positioning, from what we understand, is quite light getting into it. We have had a stellar rally until October, November 23. I think the markets were broadly in line. But since then, Fed appearing to pivot sooner than expected in November, and then BJP winning those 3 state elections in December, I think has catapulted India's market into a trajectory of its own. And that has resulted in a stellar performance, and it's only sort of par for the course that we expect some amount of pullback and reversal of things as we run into the final day of polling and the sort of exit polls that get announced on the 1st of June.
Pramod, what is your sense? I mean, if there were to be status quo, by status quo I mean, BJP gets about 303 or slightly does a shade better than what it did last term. Will the market rejoice, given that, even on a regular day where you have slightly good data from US, you tend to have a 1.5% move on the Nifty? For something that the market has been waiting for such a long time, would it rally a 2% or a 5% on that day?
It's always a difficult task to figure out what the market is factoring in already, right? But from the perspective that what do investors want, right? At the end of the day, you're not buying the market, you're buying stocks. And stocks run on earnings. And for those earnings to come through, you need a favorable economic environment. And policy making drives that favorable economic environment. To that extent, any sort of certainty on the political stability and hence policy making direction is always most welcome by the market and investors. So we're in the same boat to that extent. So whilst it's hard to predict what's going to be the reaction in any scenario, I reckon the market will look at this from a favorable perspective in the longer run. This is based on my conversations with both domestic and foreign investors. The day of the election is hard to predict, but if we do get a sort of a perceived favorable verdict, we might see a pickup in foreign inflows, which have been struggling, and we do know a lot of foreign allocators who are waiting for that event. Historically, there have been a little suspect or a little caution by the valuations, but a sort of political stability could push them over the edge in terms of making that decision. My reckoning is, even in case of a correction, there is a healthy correction, given valuations are a concern. A correction could also drive foreign inflows to come in. So I wouldn't want to second guess what's going to be the market reaction, but I think if you look at it from this framework, any sort of certainty will be more than welcome by the markets.
Sure. So everybody accepts it's hard to predict the verdict. Jigar also pointed to the the margins, the vote cap is so small in so many constituencies that it's very difficult to predict. But is it equally difficult or more difficult to predict the market reaction to these outcomes, Jigar?
Yes, I
That
guess
is an easier
numbers
ask, so please take a shot at that.
yeah, numbers ML are easier to predict than the human psychology, right? So, yes, so I'm with Pramod, right? See, eventually over the long term, earnings do drive, the stock markets. But in the medium term, I think something which is the combination of earnings plus the re-rating or de-rating of the PE multiples, right? So if you look at sort of the larger caps in India, the index is up something like 50%. The earnings are up 40%. So PE has re-rated by about 10 percentage points worth of the market performance. But if you look at the same picture for small and mid caps in particular, those variations are large. So if I look at the small cap index per se, which I'm using SEBI classification, which is companies number 250 to 500, or rather 251 to 500, that gap is meaningful. The index is up something like 70% over the last year, whereas earnings are up something like 20%. And the same number for micro cap is even more stellar. 90% market valuations up, earnings up only about 5 to 7%. And therefore, when you ask that question, that how the market reaction will be, depends a lot more on what kind of the market you are looking at. For larger caps, I think if there was an outcome where BJP plus NDA are not even able to secure a majority of 272, then I think the corrections in the small and micro cap space will be sort of very, very sharp. You could see the valuations, at least the ones that has been re-rating, completely reverse and get into a de-rating trajectory. So earnings could continue to grow at a reasonable speed, but the share price movement could be quite wild. On the other hand, larger caps may not move as much, and therefore, your incremental money could flow there, and that might be a better place to be. If there is a scenario where they get more than 272 comfortably or thereabouts, if it's thereabouts, then the immediate reaction on the market may not be one of celebration. If they get there comfortably, NDA crossing 340.50, then I think people will assume that foreign inflow will come to India, right? You look at $3.5 trillion economy going to 5. And you look sort of beyond that, what all countries do we have? We have Brazil at roughly around $1.5 trillion, but that's all commodities. You have Saudi, which is $1 trillion, that's all oil. So incrementally in the growing world, a country with a strong sort of democracy, vibrant judiciary, consumption market, which are large, foreign inflows will flow into India. Domestic savings, as we are seeing, is already flowing into India. So over the longer term, I think things would still be okay. But in the nearer term, if BJP plus NDA doesn't really is able to secure at least 272, then it's going to be a much more difficult run up to the longer term.
Sure. So, two key takeaways. The first point you're making is that small caps will see a sharper markdown, considering the fact that they have overshot or they've also beaten the frontline companies over the last year or so. But why should this be the case? Of course, you can argue that valuations are stretched and therefore the pullback has to be sharper. But what has that got to do with the government?
It's the flow, Mahalakshmi. So let me put it in two other statistical formats. Let's say if you look at the micro cap companies per se, which is company number 501 on the market cap list, going all the way down, there are total 3,250 companies in this bucket. At COVID low, the combined market cap of this segment was 5 trillion INR, so 5 lakh crores in colloquial terms. If you compare that number today, that's upwards of 32 lakh crores. Now, if you look at who owns this space, that's essentially retail. Retail owns 49% directly in the free float for these companies as a cohort, and 20% more through mutual funds. So imagine the kind of wealth that has been generated in the past 4 years because of this. 10 odd lakh crores, if you sort of add it up just in the micro cap space, there is an equal and higher number in the small cap space, which is another, say, 10 to 12 lakh crores. So 22 odd lakh crores is the wealth that is created just in the past 4 years. And that entire money has been redeployed into indices and sectors which are just running through because of low free float. So if you look at the 365 companies that have more than doubled in just the past year, 80% of them are small caps. Now, when you further look into it, you will find that companies with free float lesser than 10% have had the highest amount of increase. And as you keep going down the free float line, or as you keep increasing the free float, the gains come down, and more of this money has been parked into small cap mutual funds. So if you look at just the number of folios, they have quadrupled in under 3 years for small cap funds. And small cap number of folios are now higher than larger cap and the mid cap funds. So when you combine all of this, you realize that a lot of money has been made. That money has been rechanneled in the past 4 years into the same stocks, which has resulted in the valuation re-rating that we have seen. And that's on the basis of an assumption that there is continuity in everything that we are seeing, right? There is no new tax policy. There is no new policy with regards to how capital gains, FNO, etc. is treated, and the party goes on. If now we are questioning whether the party goes on or not, then we are going to see some amount of reversals, because had this been backed by earnings growth, you could have seen a lot more sort of stability to the downturn and the reverse effect of free float not being there, being countered. But that's not really the case from the numbers that we are seeing. It's just a lot of market exuberance and lower free float driving this. And therefore, if the government is at the center, is suggesting a change in stance, then I think that reversal of what we have seen in the past 4 years is, again, as I say, par for the course.
So what you are saying is that a negative outcome on June 4th, or anything less than 272 for NDA, which of course looks like a very unlikely scenario right now, but we are just talking about what is an outlier scenario, will change retail sentiment considerably, which therefore will have a bearing, which means that retail investors who've been really the bedrock of this market and supported market at every low, and this whole buy on dip sort of strategy which has supported most stocks, will go on the reverse, and that will create a precipitated fall in small caps. Is that what you're saying?
Yes, absolutely. And another data point to back that up, and a policy action, right? So in 2022, when you saw the global interest rates go up by quite a margin, you realize that the Nasdaq in the calendar year 2022 had fallen 35%. And with higher interest rates, right, what typically happens is that foreign institutional investors sell what's considered risky, which includes emerging markets, which includes India. Now, in that scenario, they were selling everything, and sort of the Indian markets didn't fall as much. The reason which you mentioned was that a lot of domestic money was coming in, and that supported the Indian markets. Now, part of the reason, at least in my opinion, why this money started to flow in was because of the actions that were taken by this government in terms of how they are looking at formalizing the economy. Right, DeMon, although I think this government also has stopped mentioning that, but that led to the surprise, the negative surprise that anything could happen, and therefore the intention to curb the black money was laid down. And then with GST flowing in, a large amount of unorganized economy came into the organized markets, and therefore that started a chain reaction that made, say, real estate and gold a lot less attractive asset. And it also made basically the equities, where the historical ownership is much lower, as a lot more interesting market. Now, if the alternative to this government comes through, and publicly they have sort of decried everything from DeMon to how GST has been implemented, and if they want to get into a policy action which is counter opposite to what we have seen over the past 10 years, then it suffices to say that then domestic is not here to support the market. And sort of globally, we still think that we are in the race for higher for longer in the interest rate cycle. And in that scenario, sort of everything goes for a toss in that manner.
Jigar, that's a very not a very pretty picture. Let's not go there. So Pramod, please step in. I mean, a negative outcome, will it really derail the entire party, you think? I mean, we at some level we think that some of these changes that have happened to the economy in terms of policy is irreversible. How much do you think this party can completely get derailed in case we don't have a very clear mandate?
Right. So, no, I think I agree with Jigar in terms of shorter term reaction, because sentiment does play a role in terms of shorter term reaction, and to the extent that this has been a retail driven rally, sentiment could reverse, and to that extent flows could reverse and cause a negative reaction. One difference on the flows part is the SIP piece, right? The SIP piece has become a fairly large part. To that extent, it gives some stability. There will be reversal, so the SIP piece might not overturn immediately. But stepping back and looking at the longer term direction of policy making, worth jogging our memories back to 2004 and 2009, right? 2004, we had equally negative reaction on the election day. But the next 5 years turned out to be perhaps one of the best 5 years for the Indian stock market, and also economic growth. Of course, there were excesses that got built. There were other factors, global factors, which aided that rally as well. At the same time, 2009 was the mirror opposite. The election day was greeted with a lot of cheer, but that sort of began perhaps one of the worst 5 years for the Indian market and the economy. While I tend to agree, the pace of policy making, the pace of reforms are still dependent on political stability, having a decisive mandate. But the direction of reforms have been fairly steady in India, right? Right from the liberalization, we've headed in one direction. Of course, we've had patches of policy paralysis that will remain in most of our memories. But I don't think we will take a complete U-turn on many of that fronts. The economic fundamentals are pretty much intact, whether it's in the form of demographics or the tax reforms, which is driving fiscal consolidation and financialization of household savings. I think the broad direction of the economy and policy making will remain intact, and in history, it's very difficult to see a major U-turn, right? So whether it's GST or UPI, there have been measures which have been taken over several years, and every successive governments have continued to take that baton and continue on that agenda. Of course, there will be some tweaks, particularly on the fiscal front. There might be a slightly different agenda, but I don't think it will kill the strength of the economic fundamentals materially. Like I said, the pace of reforms and execution can take a change, but a full U-turn or a longer-term impact from a negative mandate, I think is very unlikely. But yeah, short-term sentiment could mean reversal of flows, albeit some ways cushioned by the strength of the SIP flows. But longer term, I think we should remain quite sanguine.
Sure. So, if you were to weigh the, between a 20% up move for next year versus a 20% down move, how are the probabilities stacked?
I think this is perhaps different from the previous elections, to the extent that almost 3 of the 4 last elections, or almost all of them, have had or we've entered the election with a fairly weak environment from a market perspective. This is perhaps the first time where we've had a great run over 3 to 4 years. To that extent, expecting sustained rally on the markets on the positive side, even with a proper positive mandate, at least from a 1 year perspective, looks very difficult. For that, I think we do need recovery in earnings. We are seeing patchy earnings delivery across the market, across the economy. Particularly, we need strength of the private sector capex recovery, which in turn can have a snowball effect on consumption through job creation and income generation. But otherwise, calling for a 20% up move over the next 12 months, I think is less likely.
How about you, Jigar?
Yeah, I agree with Pramod. We may have very well borrowed some returns from the future. And therefore, even if you get sort of a reasonably good government, the first initial reaction could still be one of, a laid back attitude where you want to see what really transpires. And I think the thing that I am keeping an eye out on, Mahalakshmi, is the fact that you look at the increasing sort of decibel levels across, the agencies. So if you look at what RBI has done, followed by the SEBI chairman, making some announcement, followed by the finance minister herself announcing this, I think they may have been a little bit worried about how the past 6-7 years, a large part of incremental sort of lending from the bank side has gone into personal loans, both secured and unsecured. The number is as high as 80% of the incremental lending. Now, part of this money may have gone to the gaming industry, including sort of the cricket and all those analogies that you see on the IPL. As well as part of it may have flown to, the F&O markets into India. Now, if I look at RBI action, they reverted back to the risk weightages to make sure that part of this is curbed. We have already seen the GST impact being taken on the gaming companies. But so far, there have only been pronouncements or at least statement of intents by both by SEBI chairman and the finance minister on where they want to take this whole sort of excessive build out. You've never seen the market ratios of cash to F&O that you see in India in any other emerging or developed market. So if that is something they want an orderly wind down eventually, and they take some action to sort of be the villain in the shorter term so that they become the hero in the longer term, now that's something that we need to watch out that could burst the exuberance. And otherwise, every now and again, you have seen these rallies only needing, if they are sort of exuberant, you only need a superfluous reason for them to deflate. Like in 2016-17, we had a great rally in small and mid caps, but 2018 we had the long-term capital gains in Feb, and then some SEBI realignment for mutual funds, which was a flow issue and not a fundamental issue. But from the highs of Jan 2018 to middle of August 2019, you saw some 48 companies correct 80% or more, and 250 companies correct more than 60%. So whatever is unsustainable in the market eventually finds a way to topple down by its own way. And I think something like that could very well happen. Over the longer term, I'm with Pramod, India, great demography, great flows. But over the shorter term, we may have very well sort of borrowed some returns from the future.
Pramod, do you also think some adverse announcements, especially with respect to what Jigar is saying with respect to F&O, etc., could come in the budget? And will the market start to discount that right from day one if we assume political status quo?
Well, I'm not an expert on policy making, but I think the SEBI chairperson has given us a sense in some ways which way the policy making could head. Clearly, it's the right thing to do, both from an investor protection perspective and also stability of the market infrastructure perspective. Investor education awareness is important. They have done their bit. I think you can expect more on that front. What exactly will be the shape of that policy, I'm not qualified to guess, but I think the direction is something that we've already got. We need to temper down some sort of irrational exuberance in some parts of the market. Jigar has articulated it quite eloquently, particularly in the small and mid cap space, where a lot of the rally has been driven by narratives and sentiment than earnings alone. To that extent, it is the right thing in terms of pulling back some of that exuberance and directing investor focus towards longer term returns as opposed to instant gratification, and also protecting the structure of the market from very sharp moves or volatility up or down.
Sure. So now coming to portfolio positioning, Jigar, do you use any hedge and stuff like that for an event risk like this? And this time, of course, you are more bullish. So are you using anything?
No, not really. See, eventually what typically happens, Mahalakshmi, is that as a we run sort of an alternative investment desk, which is a PMS and an AIF. And theoretically, we are allowed to use sort of an option to guard the downside. But what ends up happening is that, the volatility, the implied volatility is in the protection that you seek to take goes up. And then immediately post-event, that deflates in quite a hurry. So you may well have this positioning where you are only protecting a time cover. The impact turns adverse, but the portfolio is not protected, and you end up spending 2-3% of your capital in trying to protect your portfolio. Very similar to the operation is successful, but the patient is still dead kind of an analogy, right? So the better way sort of we have found to deal with market uncertainties is, trying to manage the beta of the portfolio rather than trying either to cash in or cash out of the portfolio. So adjusting the cash flows or adjusting essentially the protection bit. So if you look at our beta positioning in the months of August 22 to March 23, where we were dialing up our small cap exposure, the beta positioning for us was upwards of 1.35 times, which in today's circumstances is down to 0.4 times. Our portfolio, which was almost 60% small and mid cap, because we run only one strategy. So that's the be all and end all, which was almost 60% small and mid caps in March 2023, is today completely flipped around to larger caps. We are at almost 55% large caps, 25% sort of higher end of the mid caps, and only 25% smaller caps. So we don't really either believe in timing or hedging, but adjusting the beta of the portfolio.
Understood. How about you, Pramod?
I mean, we're in some ways naturally hedged, given our focus on quality, where we invest in fundamentally strong businesses with cash on balance sheet as opposed to leverage, and also typically market leaders in their own sectors with strong competitive advantages. They tend to actually benefit from adverse situations. Both from a market sentiment perspective, we've seen should there be a down move, there is always a flight to safety. Flight to safety always means flight to quality, so we're likely to benefit from that move. But also in an adverse economic situation, these sort of companies tend to benefit by taking market share from the also-rans who tend to find that difficult macroeconomic environment very difficult to survive, and therefore they cede market share to the stronger ones. So given our focus on quality as a factor in our portfolio management, we are naturally hedged towards adversity, so we don't take any special hedging positions to deal with these sort of events.
And Pramod, what are your top 3 bets in terms of sectors?
I mean, more than sectors, I would say the focus remains on quality as long as returns on capital are high enough or greater than cost of capital, coupled with very high reinvestment rates, where they're seeing opportunities to reinvest their excess returns back into the business to grow future earnings. We are sector agnostic, but to the extent that at this stage of the cycle, we believe there is a private sector capex due. The government has done its bit in terms of the heavy lifting on capital investments through public infra spend. At some stage that the private sector has to take on the baton and continue to run with the investment cycle. We are more positioned towards capital goods and industrials. We wish valuations are more attractive on that front. Any event of a correction, we will double down on those bets. Alongside that, private sector financials, more from a valuation perspective, these are fantastic franchises. They've had a difficult last couple of years. While the market has gone one way, most of these high quality franchises have remained pretty much flattish. And alongside that, we are looking at a potential recovery in consumption, which has been fairly weak. From a historical valuation perspective, some of these very strong consumption franchises have had a significant derating over the last few years. So any pickup in consumption should benefit that alongside that valuation comfort.
Fair enough. Pramod, I have a question on private sector financials. I'll come to that. But before that, Jigar, now there is this, 1 lakh crore extra bounty that has come in from the RBI, which is going to be, which is something the government may not have accounted for. It definitely didn't account for it in the last budget. So where does this go? I mean, people are naturally expecting that, either they will go for, the two options, either you go for aggressive fiscal consolidation or you step up public investments even more to ensure that, you provide more growth momentum. Do you think there is a third way?
Yeah, reduce taxes.
Yeah. Expound on that. Yeah. And I ask that because, if that were to happen, will the complexion of the market and the lay of the land today change completely? Because right now, momentum areas are everything related to infrastructure, economy sensitive, so to speak, cyclicals that are coming off the lows, banks which will, write those credits, etc. Could that move into an consumption basket? And some of it, I think Pramod has been at the receiving end of some of your portfolio stocks have not performed because of that. Could that change completely if this were to happen?
Yeah, see, so I think if you look at how the entire gross fixed capital formation in India is progressing, we are actually at the precipice of something big there, right? So if you look at the GFCF, especially in comparison to GDP, there was one cycle which happened over 2012 to 2021, where the last years of Manmohan government and the first few years of Modi government were not really too keen on getting this rolling, and then the asset quality review was stepped up by the RBI, which essentially resulted in the GFCF to GDP sort of sharply slowing down after a very strong up move from 2002 to 2012, right? So sort of that was one phase. There was a second phase which brought it down. And now from 2021 across the board, so there are four components to GFCF: your central government spending, state government spending, private corporation spending, and your real estate and housing. And across all four of these pillars, we are now seeing sort of a run which has been unprecedented. Your central government spending has gone up from 6.5 to close to 11.5 lakh crores. State governments, which typically used to be 1.2 times your central government, had slowed down after COVID. That's now come back. And if you look at private corporation spending and using listed entities as a sort of sample for that, then their capex has gone up to almost 7 lakh crores or 7 trillion, which is the all-time high that at least the data that we are tracking, and real estate and housing is doing fairly well. So I think what the government tried to push through in terms of, getting the ball rolling on capex, I think that ball is now started rolling, and any incremental number either through tax buoyancy that they get or the incremental RBI dividend that they may or may not have accounted for can actually go down to bring the tax compliance lower, especially the places that they want to stimulate. At least in that instance, I think increasing the disposable incomes in the hands of a few taxpayers or using those for, the housing scheme. Because I think if you look at the rhetoric around this election as well, unemployment and sort of housing is becoming an issue. So I think in terms of portfolio tilt, we are sort of pushing this to corporate banks because those are the ones that are likely to see the growth in terms of lending. We are also increasing exposure to housing finance companies because that's another place which we think they might use this. And lastly, I think sort of the consumption businesses, not staples per se, because I think the absolute lower end of the strata is still not completely recovered. But I think to a slightly higher end, which premiumizes, I think those could be good places to be at.
Pramod, same question to you. This 1 lakh crore, do you think could actually go and change some of the things that we've been concerned about with respect to consumption? Of course, the Nielsen report came saying that, there is a momentum building in, rural recovery is happening, etc. But consumption has definitely been one piece, at least at the lower end, the mass segments. We clearly see in the numbers that companies report also that is lagging behind. Would you expect the government to change strategy in terms of where they deploy money going forward?
No, I don't think so. Given the history of this government, I think they would rather sort of create jobs rather than giving out welfare to fund the bottom of the pyramid. It has been hard. It has been hard. Like I said, private sector capex push could end up creating those jobs, which in turn will solve some of the problems on the bottom of the pyramid consumption piece. That's a far more sustainable way rather than through welfare schemes. That's been the historical positioning, and I would expect that to continue. Can you hear me now?
Sorry, I've lost you.
Hi, can you hear me now?
I can hear you. I think it's Mahalakshmi's line, I guess.
Okay.
Sorry, I seem to have lost Pramod. A couple of minutes, I hope we get back.
Yeah, so I mean, can you hear me now, Mahalakshmi?
Ma'am, can you hear me?
I can hear you, but I can't hear him. I can't do an interview without hearing.
Hi, so when Jigar and I can hear ourselves, I mean each other, I think there
As I'm just throwing this question at you, Jigar, just tell us what are your top 3 bets, and Pramod, if you can also give us your top 3 bets at this point in time.
Right, so I'll sort of have the first go at this. Yes, so as I mentioned, Mahalakshmi, see, corporate sort of facing banks are our first go. As I explained, GFCF to GDP has now sort of turned around. Last decade was all about, all these consumption-based entities, because 80% of the incremental lending was going to PL. Given that I expect some sort of policy action on curbing that down, and the GFCF to GDP incrementally going into lending part of it as well, I think corporate facing banks is one place which we have tilted to. The second space which I mentioned was housing finance companies. Clearly that's one space which will call for a lot of policy actions, and that's where we are at. The third place I think is telecom is looking increasingly interesting. We have had a reasonably large exposure there. But I think if you look at the place in terms of competitive intensity, we think we may have peaked there. Indian companies, if you look at their conference calls, want to reach an ARPU of say around 300 rupees, which is roughly $3.5 when converted. Right now, if you look at where that is in relative context, it's the lower end of where the African market is. Right, so Africa is at something like $3 to $7 of ARPU. China is $7 to $10-11. Europe is 10 to 20. US is upwards of $30. So the ambition of Indian sort of telecom companies is to reach what's the lower end of an African market. Now that's easier said than done, because the entire data architecture of Indian sort of ecosystem is based on low data rates. So the rises might be slow and steady to come by. But the direction is broadly clear that you will have to take price increases, given that the competitive intensity is now settled. So I think that's one space. So three areas: corporate banks, housing finance companies, and telecom sort of ecosystem.
Sure. Sorry, Pramod, I lost you when you were speaking. So if we can just pick up that conversation on, you were saying this government doesn't really believe in, short-term measures like putting money in the hands of people, but would want to create jobs over the long term, and that's the sustainable strategy. That is where I lost you. If you can continue from there.
Yeah, based on the historical track record, the government has been particularly strong in terms of fiscal management. Given that we still have some ground to cover in terms of the correction of the fiscal stimulus that we gave during COVID, this 1 lakh crore additional income comes as a windfall in terms of accelerating that move towards getting below 4% fiscal deficit. So some of that will help. But given that we were already on that trajectory, should the government use, I would reckon they would rather look at triggering a capex cycle, which in turn can create jobs and income generation and a sustainable way to drive consumption. than any sort of shorter term measures. That was the point I was trying to make.
Pramod, I'm also asking this question, and in the wake of the fact that now you see every day IT jobs, or layoffs are making headlines, and so obviously job creation is an important issue. And if that doesn't, we've often talked about private capex not coming up, but if we talk to a lot of corporates, they do say that they don't see very sustained demand. Now, that's one of the reasons in various areas you don't see capex growth or capacity expansion. So how do you bridge that? Because some of these things are very long term, but you have an immediate problem to solve over the next 5 years, which is obviously the window that most governments have.
Right. No, I mean, I wouldn't want to be in the government's position, because this is a hard problem to solve, and particularly we are entering an era where even if you drive manufacturing growth, given the increased use of automation, it may not necessarily translate to job creation much like it did perhaps a decade ago. So it is a harder problem to solve. So I guess a mix of both. You might need some sort of welfare support to the bottom of the pyramid. The government has doing its bit in terms of food security as well as employment guarantee schemes. But the more sustainable way has to be through job creation. While manufacturing can do some of the heavy lifting, we will still remain a services-driven economy. We have a great opportunity to become a services exporter. The sort of boom in GCCs, or they call as global capability centers, where India becomes the source of a lot of this, job creation can come in from that sector. However, there are perhaps structural headwinds there as well with the advent of generative AI. It's early days, but at least it seems like even services could get disrupted in terms of machines replacing humans. But I'm a lot more positive. Humans will figure out other ways to employ themselves. But I think it's a mix of both services and manufacturing, which will help create that job creation. It's easier said than done. Like I said, I wouldn't want to be in the government's position to solve this sort of quandary.
Fair enough. And therefore, how do you position yourself? I mean, of course, you said, high return, you're more bottom up investor, focus on quality companies, etc. But you can still tell us, are there any pockets in consumption that you particularly focus on? You said capital goods, but any particular pockets in capital goods that you find exciting?
Yeah, so in capital goods, I think there is myriad of areas which should benefit if we see an industrial recovery and manufacturing recovery, particularly driven by the PLI schemes on the supply side. From the demand side, we are seeing moves on the China Plus One scheme, where there is reshoring of supply chains. Of course, we can't replace China, but even if we take a fraction of market share from the global supply chain from China, I guess there is much to be had given the low base that we're coming off. So there are benefits in specific sectors. There are policy push, particularly in the area of renewables, say electric vehicles, semiconductors, pharmaceutical APIs, so on and so forth, which are strategically important industries, including defense, for example. Railways, there's been a push. So any sort of sectors which are exposed to these sort of demand drivers will be of interest to us. The second piece, like I said, is private sector financials. I tend to agree with Jigar there. Corporate lending hasn't really taken off. This will be a fallout of the growth in manufacturing as well. If there is private sector capex, there will be a takeoff in corporate lending, and that should benefit some of the private sector banks, which are available at fairly attractive valuations based on their historical levels. And within consumption, again, I tend to agree with Jigar. There has been a K-shaped recovery. Premiumization will remain the theme, but at the same time, we will keep a lookout for any sort of pickup in the bottom of pyramid consumption there. Where a lot of the staples companies have had a long hiatus in terms of both earnings growth as well as stock price recovery. To that extent, valuations are a lot more palatable today than they were 3 to 4 years ago. So we will keep a lookout for any sort of recovery and low ticket consumption as well.
Sure, we are running out of time. Thank you so much, Pramod, Jigar. Thank you so much for joining me this morning.
Thanks for inviting us again.